Good evening, students. Welcome to the session. I'm assuming that you have revised the session as I always do it. So, I'm first going to take up the questions on the MAT and then we are going to progress further because we have already completed entirely MAT. Only few things are remaining. Yes, Kaushiki, good evening. So, let's get quickly started with it. First, we are going to deal with the question from your module. If you would have revised, then it would be really fast. And if you have not, then it's going to take time. Okay, let's see. So, first question from your module, the illustration 1, which is there. I'm just going to share the screen of your module. Okay, a domestic company, ABC Limited, furnishes the following particulars in respect of assessment year 22-23 and seeks your opinion on the following on the application of 115 JB. You're also required to compute the total income and tax payable. Profits 215 lakhs. Statement of P&L includes dividend income from Indian company. Excess realized on sale of investment held as investment 30 lakhs. Depreciation on SLM basis 100 lakhs. Provision for loss of subsidiary company 60 lakh. Depreciation allowable as per income tax rules 150. Short-term capital gain on sale of land mentioned above as computed under Income Tax Act 40 lakhs. Losses brought forward as per books of accounts and as per Income Tax Act 50 lakhs. Unabsorbed depreciation 60 lakh. You will have to deal with this issue assuming ABC is not required to comply with the Indian accounting standards. Ignore 115 BAA. Turnover of the ABC accounting for previous year 1920 was rupees 390 crores. So yes, get started. Yes, quickly get started with the sum. Good evening, Viraj. I'm giving you 10 minutes time to solve the question. Yes, students. Tell me the answers. What is the normal income tax, first of all? What is the normal income tax? No, Kaushiki, that's not the correct answer. Okay, let's solve together one by one. First is profit as per the statement of P&L 215 lakh, which you will take first, right? Then dividend income from Indian companies 20 lakh. What will be the effect of this? What will be the effect of 20 lakhs dividend income? Yes, Kaushiki will reduce. Yes, Viraj. And what will be the other effect? There will be two effects, right? Yes, Geeta, correct. It will be reduced and then it will be considered as income from other sources. Yes. So do not forget that you take it as income from other source. Okay. Next one. Excess realized on sale of land held as investment 30 lakhs. What would you do with it? Excess realized on sale of land. Past. Reduced from profit. And are you at CG? Income under the head CG. Okay. Kaushiki. Yes. Why would you deduct 50? Okay, Viraj, I understood deduct 50 as in dividend as well as the CG, right? Add rupees 160. How 160, Viraj? The total you are saying of all the items. Okay, let me see how much is the total. Excess on land, dedicated and yes. So deducted, Geeta, yes, correct. And then income from capital gain. What would you include as income from capital gain? 30? Is 30 the income from capital gain? Is 30 the income from capital gain? Yes, Kaushiki. It's 40, not 30. Short-term capital gain, fourth point on sale of land mentioned above is 40 lakh. 30 lakh is the book gain. So you will reduce 30 and you will consider income under the head capital gain as 40. Clear? Then debits are depreciation on SLM basis. This you will add back 100 lakhs very clearly. Then depreciation allowable as per income tax rules, you will reduce 150. Provision for loss of subsidiary company, what would you do? Provision for loss of subsidiary company. Yes, Kaushiki will add it back because it's a provision, so that would not be allowed. So provision for loss of subsidiary company, you will add it back. You will not get any allowance for that even under the normal provision. Are we clear? So 215 in the add, you will add 100 plus 60 Viraj, not only 100. So provision for losses of subsidiary provisions are not allowed. So 160, unless you would do dividend, 30 of the sale on land, depreciation as per the income tax rule 150. So 215 add 160 less 200, the business income comes to 175. Then you have the brought forward losses and the unabsorbed depreciation. Now the priority is always to set off the brought forward losses first. So you will set it off 50 first from the brought forward losses, which gives you 125. And then you can add even the capital gains and income from other sources. I'll show you how the presentation is to be done. So if you see here, 125 is there. 125 is the business income. Then I'm directly writing capital gain and income from other sources because unabsorbed depreciation can even be set it off against the capital gain and other sources. It need not only be set off only against the business income because this is assumed to be the current year depreciation. This is deemed to be the current year depreciation. Okay. So 60 will be reduced from all these incomes, right? Not only the business income, but capital gain and income from other sources both. So 125 is my total income. Now, what would be the tax liability on this? On 125? What is my tax liability? Viraj, you do not have to deduct the provision for loss. It is already debited to the P&L. So you will have to add back. Kaushiki, no, that's not the correct answer. You have not revised. What would be the tax rate? Let me see who gives the correct answer. Yes, Geeta, very good. 25% will be the tax rate. Why, Geeta, you have taken as 25%? Yes, Dilip, very good. Since the turnover is less than 400 crores of previous year 1920, therefore, in that particular case, the tax rate would be 25%. Kaushiki, again, put it in your books so that you do not make this mistake in the exam with the red pen. That you need to check the turnover. See, when I was studying, I used to do it in the same way. I used to put it in the red marking, whatever I used to make the mistake, so that it comes to my eyes when I'm writing the exam. Are we clear? So, Geeta, 25%, yes, because the turnover is up to 400 crores. So, give me the total tax payable under the normal provision. So, what is the total tax payable? Yes, Geeta, very correct. It's 34 lakh 77,500. Is everybody getting that answer? Yes, Dilip, 34 lakh 77,500. That's very correct. Everyone getting that? Anybody not getting that? Anyone not getting? Please put it in chat box what you're getting as the answer. Okay, Viraj, understood. Anyone not getting 34? All of you are getting 34. You need to add surcharge of 7% as well because your income is exceeding 1 CR. Right? So you need to add the surcharge as well. Do not again forget that. Good, Vinay. Okay. Now let's go to the MAT. Let's see what is the MAT liability. So profit as per the P&L is 215. What about the dividend income from Indian companies under the MAT? Now under the MAT, what adjustments you will make? Let me see. Dividend income. No adjustment, Dilip. Yes, correct. For dividend, there will be no adjustment under MAT. You will not take it into income from other sources for the purposes of MAT. Excess realized on sale of land held as investment 30 lakhs. No adjustment. Yes, Kaushiki. So you will take 30 lakhs only. So you will not even put up short-term capital gains of 40 lakhs in the book profit. Okay. Depreciation on straight line method basis. What you would do? Depreciation on the straight line. What needs to be done? Yes, Geeta, no adjustment for dividend. What about the depreciation? Depreciation, you will make an adjustment, although there would not be any effect, Geeta. So what you need to do is, see, I'll take you to the adjustment part. See, depreciation as per books of accounts, 100. You will add back. And again, you will reduce depreciation as per books of account. Because in this question, there is no depreciation attributable to the revalued assets. So in this case, there will not be any effect. But otherwise, in case there would have been any effect in terms of the revalued assets, the depreciation on that, then your depreciation on the revalued asset had to be disallowed. So the presentation you will have to do in this manner, add depreciation, less depreciation as per books of accounts only. Okay. Next one, provision for loss of subsidiary company. Yes, Geeta, correct. Viraj, you have to add back and then again you have to reduce. Add back provision. Yes, Kaushiki, correct. Correct, Geeta. So you need to add back the provision. So what is your MAT book profit coming to? What is a MAT book profit? Okay, we have forgotten one more thing. Losses brought forward as per the books of accounts. Business loss, unabsorbed depreciation. What will be the effect of this? Any amount transferred to reserve caution you need to add back, but in this question, there is nothing like that. SLM depreciation only I'm saying, Viraj, that you need to add and then again you need to reduce. Because under the MAT, you don't reduce as per the Income Tax Act, you add back and reduce the same as per the book depreciation. Yes, Geeta, business loss or depreciation, whichever is lower, will be given effect. So here 50 or 60 lakhs, which is lower is 50 lakhs. So that will be reduced. So what will be your book profit? Dilip, what is WIH or WIL? No, Vinay, 245 lakh is not the book profit. You have not reduced the loss. Yes, Geeta, 225 lakh is the book profit. $225 lakh is the book profit, okay? Now, what is the MAT liability? Delete whichever is lower we take for losses, not the higher. What is the MAT liability? Yes, Dilip, it is 37.5570, which is 37,55,700. Very correct. All of you are getting that answer? Yes, Geeta. So, tax at the rate of 15% on 225 lakhs, you will again add surcharge because your book profit is exceeding 1 CR. So, your MAT will be 37,55,700. Now, the normal tax was 34 lakh and the MAT is 37 lakh. So, 15% of the book profit is exceeding the normal income tax. Therefore, the book profit would then be deemed to be the total income. You will write like this in your exam. Book profit would be deemed to be the total income and the tax on that will be 37,55,700. So this is going to be your tax liability. Are we clear? Any doubt? So this is going to be your tax liability. Clear? Are we clear? Any doubt? Yes, Vinay, correct. Now, if you see, there is a difference between the MAT and the normal provision. The differential amount which is there, the differential amount which is going to be there, that will be allowed to you as the MAT credit. That will be allowed to you as the MAT credit. So you can here write it down. MAT credit, which is your MAT liability minus your normal tax liability. This is your MAT credit, which is allowed to you when you start again paying the tax as per the normal provision. So where the tax under the MAT provision is in excess of the normal tax, right? Then the tax credit or the MAT credit will be allowed to you in the subsequent year. The tax credit will be allowed to you in the subsequent year, and this is allowed for 15 assessment years. 15 assessment years succeeding the year in which the credit becomes allowable. Now, this MAT credit will be set off against the tax payable on the total income in the year in which you have the normal tax computation. Are we clear? So let's say, for example, in this particular case, your MAT credit will then be 37 lakh minus 34 lakh. This is your MAT credit, and this will be allowed to you in the year in which you pay as per the normal provisions. Are we clear? Let me give you an example. Let's say for 1920, my MAT liability is 4,50,000, right? Normal tax is coming to, let's say, 3.95 lakh. I paid as per MAT. So MAT credit will be, let's say, 50,000. Let's say in 2020, 21, I will have, let's say, 4.7 lakh as the MAT, 4.10 lakh as per normal tax. So of course, I'll be again going with the MAT. So again, I will have 55,000. Sorry, this is 55. Right, here I will have 60,000 as the MAT credit. Now my total MAT credit will be this, right? Now let's say in 21, 22, I will have, let's say, MAT as 3.8 lakh. Total tax as per normal provision is 4 lakh. So I am obviously paying 4 lakh as the tax. I am going as per the normal provision, correct? Now what will happen in that particular case is, I will be allowed the MAT credit. I will be allowed the MAT credit of the difference between these two, which is 20,000. And I will have to pay the actual tax of 3.8 lakh. I will have to pay the 3.8 lakh as the tax payable. And the balance MAT credit will then be, this is 1,50,000. Out of this, 20,000 will be reduced. The balance credit will remain as 95,000. Are we clear? Are we clear? So the MAT credit will be allowed to you in the year in which you pay the tax as per the normal provision. Now, in case where there is a conversion of a company or where there is an amalgamation, right? So in that particular case, the MAT credit is allowed to you. In case of amalgamation, the MAT credit can be carried forward. But in case there is a conversion of a company to an LLP, now the company loses its form and becomes LLP. So then in that case, that MAT credit would not be allowed to the LLP because LLP is not liable for MAT, right? So in that case, the MAT will lapse. The MAT credit will lapse. Similarly, if you opt in for 115BAA provision, wherein 22% tax is allowed to you, and if you have MAT credit which is pending, then you will have to take a call. This could be part of the exam question at any time, right? So in case the question says that there is a MAT credit which is lying of the earlier years, in this year you are planning to opt for 22% provision under 115BAA. So what you will have to do is, in that question, please note this point. You will have to first compute the tax as per the normal provisions. You will have to compute the MAT also. You will first give the MAT credit and see what is the tax which is coming to. And then what you will do is, you will compute the tax as per 115BAA at 22% and compare what is beneficial, whether to lose out the MAT credit is more beneficial, or first you exhaust the MAT credit and then exercise 115BAA in subsequent years. Right? Any doubt? Vinay, which treatment of dividend? I told you that treatment of dividend is you will have to add it back. and take it into income from, so you have to reduce and include it in the income from other sources. That I showed from module only, Vinay. Yes, Dilip. Okay. Shall we solve one more question on MAT? Okay. Let's solve one more question. Again, a very small question from your module only. Sona Limited, a resident company, earned a profit of 15 lakhs after the debit or credit of the following items to its statement of P&L: provision for the loss of the subsidiary, provision for doubtful debts, provision for income tax, provision for gratuity based on actuarial valuation, depreciation, interest to financial institution unpaid before filing of return, penalty for infraction of law, profit from unit established in SEZ, share in income of AOP as member, income from units of UTI, long-term capital gain on sale of building. Depreciation includes 150 on account of revaluation of fixed assets. Depreciation as per income tax rules is 280. Brought forward loss as per books of accounts is 10 lakh, which includes unabsorbed depreciation of 4 lakhs. AOPs of which the company is a member has paid the tax at MMR. Provision for income tax includes 45,000 of interest payable on income tax. Compute the MAT assuming that it is not required to comply with Ind AS and ignore the provisions of 115 BAA. So get started. Giving you 10 minutes time, think about it, and then quickly tell me the answers, okay? The leap MAT credit, as I said, for 15 assessment years can be carried forward. Yes, students. So what is the answer which is coming to? Yes, Viraj, correct. Addition is right. It's 6,10,000. What you have added is correct. How much you will have to reduce? Let's solve it together. Provision for the loss of subsidiary 70,000. We just did it. It will have to be added back. Correct? Then next one is provision for doubtful debts 75,000. What will be the effect? Provision for doubtful debts. Yes, Geeta, very nice. 14 lakh is the book profit. Yes, Geeta, add doubtful debts, that's correct. Then provision for income tax 1,05,000. What we need to do? Yes, Viraj, provision for doubtful debts is to be added. Yes, Geeta, income tax provision also needs to be added. Then next one is the provision for gratuity based on actuarial valuation, 2 lakhs. What do we need to do? What do we need to do? Provision for gratuity, no Kaushiki, we need not add it back. So provision for gratuity based on actuarial valuation, do we need to add it back? Yes, Geeta. Why there is no effect for actuarial gratuity? Any reason, Geeta? The gratuity provision which is based on actuarial valuation will not be added back. Any reason? The reason is simple. Since this is based on the valuation by an actuary, this is a certain liability. So the actuaries value the gratuity provision to be made depending on the past claims, depending on the employees which will retire during the year. So this is based on the actual or more or less, not actually even if we say, but more or less on a scientific basis. This is not a random provision. So this is a certain liability, hence the same should not be added back to the book profit. Okay. Viraj, this is not a business expense. It is a business expense, but that's not the reason for not adding it back. Okay. Next one is the depreciation, 3,60,000. What do we need to do? Depreciation. Add depreciation. Okay. Yes, that's correct. Next is interest to the financial institution, 1 lakh. Interest to the financial institution unpaid. Yes, Jacob, depreciation you need to add back. Interest paid to the financial institution. No effect of interest. That's correct, Geeta. Why no effect? So in exam, you are required to write the reasons as well, not just add or less. So what is the reason, Geeta? Expense in earning income. No, Kaushiki, that's not the correct answer. Okay, so the reason for that is that only the specific adjustments which are provided under explanation 1 to 115 JB are required to be made to the book profit. Now, interest to the financial institution which is unpaid before the filing of return would have been disallowed under the normal provisions because this is as per section 43B. But there is no adjustment which is there under explanation 1 to 115 JB in this regard. So therefore, it will not be added back under book profit calculation. Clear? Okay. Next one is the penalty for infraction of law 50,000. Yes, Chekhov, correct. Penalty for infraction of law 50,000. What do we need to do? Yes, Geeta, that was the correct reason. Yes. Not added back, Jacob. Yes. And give me the reason also. Why should we not add the penalty for infraction of law? Because under the normal provisions, under section 37, penalty for infraction of law will be disallowed. Why we should not add it back in the MAT? Yes, Kaushiki, again the same reason, because no specified adjustment is provided under explanation 1 to 115 JB. Clear? Okay. Then items credited. Profit from unit established in SEZ 5 lakh. Profit from unit established in SEZ. No, Jacob, we need not deduct it. The profits from the unit of SEZ is exempt under section 10AA, or there is a deduction available under 10AA. But under 115 JB, there is no specified adjustment in that regard. So yes, Geeta, you're correct that there will not be any deduction for the profit from the unit of SEZ. Clear, Jacob? Okay. Next, share in an income of an AOP as a member. Share in income of an AOP as a member 1 lakh. What do we need to do? Yes, Jacob, you will deduct it. And what is the reason? So again, under explanation 1 to 115 JB, if you remember, we had done it in the last class, that share in the income of an AOP as a member need to be deducted, because in a case where AOP has paid the tax on the total income at the maximum marginal rate, the member will not be required to pay any income tax as per the provisions of section 86, which we will be seeing in the next class. Therefore, share of the member of the AOP on which no income tax is required to be paid by the member, because the AOP has already paid the tax as per section 86, then that will be reduced from the book profits. Clear? Next is income from units of UTI 75,000. Income from units of UTI 75,000. No adjustment. Yes, perfect, Jacob, because this is taxable in the hands of the unit holders, and therefore if it is included in the book profit, there would not be any adjustment with regard to that. There is no exemption for the units of UTI under section 10. Then long-term capital gains on sale of building 3 lakh rupees. Long-term capital gain on sale of buildings. No deduction. Yes. Yes, Geeta, you are correct. For long-term capital gain, there will not be any adjustment because this is not to be excluded as per any of the adjustments which are specified in the explanation 1 to 115 GB. Then there are other information which are available. Depreciation includes 150 on account of revaluation of the fixed assets. What do you need to do? Yes, Geeta. Deduct revalued depreciation. So how will you make the presentation, Viraj? What will be the presentation? We have already added 3,60,000. Yes, Chekhov, you need to reduce 2,10,000. So if you remember, we have already added back the depreciation as per books 3,60,000. This is what I was telling you in the last sum also. In this particular question, what you will do is 3,60,000 minus 1,50,000 on account of revaluation. You will reduce. So 2,10,000 is what you will less from the book profit. I can show you. See. Depreciation 3,60,000 added back, and what is reduced here is depreciation 3,60,000 minus 1,50,000, 2,10,000 is reduced. In effect, you are adding back 1,50,000. But in exam, you will not add directly 1,50,000. What you will do is in the same manner. Add 3,60,000, reduce 3,60,000 minus 1,50,000, 2,10,000. Clear? Is this clear? Okay. Next is the depreciation as per income tax rules. For this, no effect is required to be given. You will not consider depreciation as per income tax rules under MAT. Brought forward business loss as per the books of account is 10 lakhs, which includes the unabsorbed depreciation of rupees 4 lakhs. What you would do? Yes, Viraj. Yes, Geeta, correct. 4 lakh or 6 lakh, whichever is lower, and not 4 lakhs or 10 lakhs. So, yes, Vinay, you are correct. So, 4 lakhs or 6 lakh, whichever is lower. So, 4 lakhs is lower, you will take 4 lakhs into account. So, that you will reduce. So, you will get the book profit of 14 lakhs. Then, the last two adjustments are the AOPs of which the company is a member has paid the tax at the MMR. So, this is what we already considered. Provision for income tax includes 45,000 of interest payable on income tax. So, interest payable on income tax is also not allowed. So, that also we have disallowed entirely. Now, what will be your MAT liability? What is your MAT liability? Please tell me very quickly. $218,400. Yes, Geeta, you are correct. 15%, and here there is no surcharge. Okay. So 218,400. Are we clear? Okay. Next question, please take it down. This is on the OCI items, Ind AS compliant company. ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu. In Tamil Nadu, started adoption of Ind AS compliance or started adopting Ind AS with effect from 1st April 2020. The following particulars are furnished for 31st March 2023. The book profits after adjustments of all the items specified in section 115JB2 amounted to rupees 52.26 lakhs, except for the adjustment of brought forward losses. For the year ended 31st March 2023, brought forward business loss as per books of accounts rupees in lakhs, financial year 2020-21, brought forward loss is 4.60, unabsorbed depreciation is 4.90. For 21 financial year 22, it is 1.75 and 2.20. The business loss of rupees 4.60, the business loss of rupees 4.60 and 1.75 lakh have been deducted while computing book profits. Under section 115JB, for the financial year 2020-21 and 21-22. Clear? Respectively. The particulars of OCI, for the year ended 31st March 23, rupees in lakhs. OCI that may be reclassified to P&L. That may be reclassified to P&L. This is your past exam question only. Debit, credit. Deferred gain cash flow deferred gain cash flow 5.50 on the credit side. Cash flow hedges. Second, deferred cost of hedging. Deferred cost of hedging 1 on the debit side. Comprehensive income from discontinued operations. Comprehensive income from discontinued operations. $4.20 on the credit side. Exchange differences of forex operations. Of forex operations. 2.30 on the debit side. Total 3.30 on the debit side and 9.70 on the credit side. OCI that will not be reclassified to P&L. Changes in the fair value of equity instrument. Changes in the fair value of equity instruments. 10 on the debit side. Deferred gains on cash flow hedges. Deferred gains on cash flow hedges. 7.25 on the credit side. Deferred cost of hedging. Deferred cost of hedging 4.10. Share of OCI of other associates. Of other associates. 3.20 on the debit side, credit side. Remeasurements of post-employment benefit obligations. Post-employment benefit obligations. 4.45 on the credit side. Last, revaluation surplus of assets. Revaluation surplus of assets. 7.50 on the credit side. Total debit 14.10. Total credit 22.40. The transition amount as on the convergence date, that is 1/4/2020, stood at rupees 52.50 lakh. Credit balance. Includes capital reserve of rupees 8 lakhs and adjustment of rupees 4.5 lakh relating to transition difference in foreign operations. Last point, the NCLT has admitted the application under Section 7 of IBC made by the financial creditor against the company for initiation of insolvency proceedings. For the initiation of the insolvency resolution process on 31st March 23. Assume income tax liability is rupees 9.20 lakh. You are required to compute the MAT. So go through the question for 5 minutes and then we will solve it together. Vinay, dividend treatment I have not to write because that is being specifically considered there, right? In the module only, that's what I'm saying. So dividend income, when I understand one thing, that this is reduced from the normal provisions, normal business profits, because this is the income from other source. We have done that in the earlier classes also, that income from other sources has this specific section 56 where dividend income is considered specifically therein. So if you're computing under the normal provisions, I'm not talking about book profit. Book profit, the dividend is not to be adjusted. I'm talking about the normal business computation or the normal total income computation, right? There I am saying that dividend you'll have to reduce from business income and add to the income from other sources. Which notes of last class you're saying, Vinay? I'm not saying that dividend is not to be make any adjustment under book profits. Understand that thing. I was saying about the normal tax computation and we have not discussed this in the last class. We have discussed in the income from other sources class. Jacob, yes, provision for gratuity. See, there are the actuaries, which is like professional, like we are chartered accountants. There is a body of actuaries also, and the actuaries do the valuation exercise. They are professionals for that. So now when they make the provisions, okay, or they determine the provisions basically based on the actuaries report, if you make the provision, that is a certain liability. So this could not be only for gratuity, it could have been even for, let's say, the warranties. So what they do is, let's say for warranties, they would determine how many customers claim the warranties in last 5 years, in last 10 years. And based on the estimation, which is based on the scientific evidence or scientific calculation, they would make the estimates. So this is more or less the ascertained liability rather than the unascertained liability. So provision for unascertained liabilities have to be added back, as I mentioned in the last class. But provision for ascertained liabilities need not be added back. That is allowed, even under the book profit. So similarly for gratuities, what they do is they determine how many employees usually retire, what is their age during which they claim these particular compensation, so, and what are the current age of the employees who are working. So based on that, they will calculate on a scientific basis that what would be the gratuity. So this is an ascertained liability rather than the unascertained liability. Clear, Jacob? Have you gone through the question? No, these are the gross figures, Vinay. This is the exam question. Yes, Kaushiki. Okay. So let's start solving this particular question. So ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu, started the adoption of Ind AS with effect from 1st April 2020. Following particulars are furnished for 31st March 2022. Now, what are the particulars which are furnished? So here they are saying that first, that the book profits after adjustments of all the items, so whatever adjustments are specified in the explanation, that amounts to 52.26 lakh. So we'll take that as the book profit starting point. So computation of MAT as per section 115 JB. Book profit after the adjustments under section 115 JB. What is the amount of book profit? It is 52.26 lakhs. Right? Next is, they are saying that brought forward business losses as per books of account for the financial year 2020-21 and 21-22, they have given the business loss and the unabsorbed depreciation. So in this case, they are saying that the business loss of 4.6 and 1.75 have been deducted while computing the book profits of the relevant assessment years. So what you are required to do, tell me now. What is the adjustment? No, Kaushiki, that's not the correct answer. Will that make any difference? So you're saying add back business loss until all the adjustments are made. That will not make any difference here. Because any which ways, what is the brought forward loss or the unabsorbed depreciation is any which ways allowed. Go through the entire question and tell me. Viraj, it is already deducted. The business losses are already deducted while computing the book profit of the earlier years. Yes, Kaushiki, no adjustment for the business loss is correct. But still, let me see who gives me the correct answer which is there. If you have revised yesterday's class properly, no, Kaushiki, that's very incorrect answer. Lower is deducted from both here. That is applicable only in the cases where the application has not been moved for IBC. So what you're saying, Kaushiki, that lower of unabsorbed depreciation or business loss is allowed, that is correct. But that is not when the application is moved for IBC. If you remember our last class, what did I say? brought forward loss or unabsorbed depreciation if the companies are undergoing the IBC proceedings, then the aggregate of the brought forward and the unabsorbed depreciation is allowed. So, if you see the last line now here in the question that I gave you, NCLT has admitted the application under IBC. So here, even the unabsorbed depreciation will be allowed. So brought forward losses have already been claimed as deduction. The unabsorbed depreciation was not claimed. The aggregate of both is allowed. So for brought forward losses, I'll not make any adjustment. But for the unabsorbed depreciation, I will get the deduction. So write it down in your notebook in the red pen, less aggregate of unabsorbed depreciation, since brought forward losses are already claimed in respective AYs. UAD is also required to be claimed for company under IBC. So what is the unabsorbed depreciation which is there? It is 4.9 plus 2.2. So 4.9 plus 2.2 which is there. That needs to be considered over here. Are we clear? Are we clear? What is the total amount which is coming to? What is the total amount? No, Vinay, that is not the correct answer. Now you understand it is the aggregate of both the years you need to consider. Clear, Vinay? What is the total amount you're getting? Kaushiki, 52.2 minus 7.1. Okay, 7.1 is the total amount you're getting. Okay. Okay. So this is how much coming to total? 7.1, which is 4.9 plus 2.2. Okay. Next, OCI. The particulars of the OCI for the year are given. OCI that may be reclassified to P&L, deferred gain cash flow hedges, deferred cost of hedging, comprehensive income from discontinued operation, and exchange difference of forex operation. What will be the effect of these? Yes, Geeta, it is 7.1 correct. Clear, Vinay? Yes. Yes, Vinay, very good. Items that will be reclassified to P&L, for them, there is no adjustment which is required. So here, no adjustments for items reclassified to P&L. You remember that? For items reclassified to P&L, there is no adjustment which is required. OCI that will not be reclassified to P&L. For this, the adjustments will be required. So for this only, the adjustments are required. Now I'm taking you back to my last class. If you remember, OCI items that will not be reclassified to P&L, for this the adjustments are to be made. add all amounts credited to OCI less all amounts debited to OCI. No adjustment for revaluation of assets, gain or losses from investment in equity instruments designated at the fair value through the OCI. The adjustment will be made only when the asset or investment is actually retired, disposed, released, or transferred. Okay, so now in this particular case, tell me, what will you do? What will be the OCI items that you will consider and what you will not consider? Yes, Vinay, no adjustment for fair value of equity instruments. That's very correct. No adjustment will be made for that. That has to be excluded. So changes in the fair value of equity instruments, that will not be considered. Okay, so this is for this, no adjustment required. What about deferred gains on cash flow hedges? Yes, Kaushiki, you are correct. Even for revaluation surplus of assets, no adjustment is required. Are we clear? So you will only consider this and this. Just write it down. Add items debited to OCI. That may be, that may not be, or that will not be reclassified to P&L. So first is the 4.10, which is deferred cost of hedging. Deferred cost of hedging 4.10 less items credited to OCI that will not be reclassified to P&L. And what are the amounts? First is the deferred gains on cash flow hedges, 7.25. Deferred gains on cash flow hedges, 7.25 lakh. Next is the share of OCI of the other associates. Share of OCI of other associates. What is the amount of that? 3.20. 3.20. Next is remeasurements of post-employment benefit. Remeasurements of post-employment benefits, benefit obligations, 4.45. So these are the effects you will make over here. So as I said, you would add all the items credited to the OCI and less all the items debited to OCI. Okay, we have done here reverse way. Sorry, this needs to be less and this needs to be add. Okay. So the items credited will be added and the items debited will be reduced. So 7.25, 3.20 and 4.45. Are we clear? Any doubt? Yes, 14.9 add, 4.1 reduce, correct Kaushiki. Okay. Next is, what is the next adjustment? The transition amount as on the convergence date stood at rupees 52.50 lakh, including the capital reserve of 8 lakh, and adjustment of 4.5 lakh relating to the transition difference in the foreign operations. What is the effect of this? So what did I tell you in the last class? Transition amount 1/5 for the year of convergence plus 4 succeeding previous year. Amount adjusted in the other equity excluding the capital reserve, excluding the capital reserves. So capital reserves are to be excluded from the other equity and excluding also the amount of adjustment relating to the cumulative transition difference on foreign operations. So in this case, if you see, the 52.50 includes capital reserve. So you will reduce capital reserve. You will also reduce the transition difference on foreign operations of 4.5. So less the transition amount or 1/5 of transition amount, which is 52.5 minus 8 minus 4.5 lakh. What is the amount coming to? 1/5 of that? 1/5 of that, what is it coming to? Yes, Kaushiki, 8 lakhs. So 1/5 of not 52.5 lakh, but 1/5 of 52.5 minus 8 minus 4.5. So what is your book profit coming to? Calculate the book profit for me. Calculate the book profit and the MAT for me. Yes, very quickly calculate. What is it? 52.26 minus 7.1 plus 4.10. Sorry, less 4.10. This is less. Plus 7.25, 3.20 and 4.45 minus 8 lakhs. So what is your book profit coming to? Sorry, this is 1/5 of transition amount which is there. This is credit and not debited. So this will be added and not deducted. So transition amount was the credit amount. If you see this, transition amount, this is a credit balance. So this will be added. 8 lakhs will be added here. So 63.96 is my book profit. Jacob, Vinay, yes, it was my mistake that I have written less of this thing, transition amount, but this needs to be added because this was the credit balance. Okay, it was the credit balance. Vinay, 8.58 is not the right answer. Kaushiki, 7.9194, no. Yes. Viraj, it is 63.95. Yes. Geeta, no, it is 63.96, not 55.96. Okay. MAT at the rate of 15% here comes to, MAT will come to 9.97 lakhs. 1/5 of the transition amount needs to be added because this was credit balance and not the debit balance. Yes. 9.97. Yes, correct, Vinay. Now, what is my normal tax liability? It is given in the question. What is my normal tax liability which is given? 9.20 lakh. So this is less. So therefore, MAT will be applicable. Therefore, my MAT credit will be 0.77 lakh. Of course, you will also add the cess over here. You will also add the cess over here. Okay. Okay. Are we clear? Is the MAT clear? Any questions? Okay. So now this covers your entire MAT. What is remaining is 2 points just. One is the foreign tax credit and the MAT credit and few case laws which we need to discuss. Once we are done with that, we'll move on to the next provision. So let's take a small break of 10 minutes and then we get back. Okay, let's take a break of 10 minutes. Okay. Yes, students, let's get quickly started. Okay. Now the next part, as I said, is, see, I told you that what is done after that MAT is applicable is that the book profits would be deemed to be the total income. See, once the 15% of your book profit is higher than your normal tax, right? Then the book profits will be deemed to be the total income. Understand that thing. Now, if it is deemed to be the total income, the normal provisions of the Act will be applicable. Now, what do we mean by the normal provisions? So, whether advance tax needs to be paid even if you are going under MAT, the answer to that is yes. So, Supreme Court in Volta, India, you can write down the case. Supreme Court in Volta, India, had held that all the provisions of the Act will apply to even the company which is opting for MAT or which is going under the MAT, not opting. So even the advance tax provision will be attracted. So if it has not paid the advance tax, then the interest under 234B and 234C will be applicable on such company. Are we clear? So therefore, had held that 234B and C would be applicable to company opting for 115JB or company not opting for, company required to pay as per section 115JB. Are we clear? There are few additional cases also in this regard. Now there was one particular case that where the question was before the court that whether 54 exemption which is there, whether that will be applicable or not, like 54 EC which is there. Now if I have paid the capital gains, if I have the capital gains and I have claimed the 54 EC exemption in the normal provisions, whether I can also claim the 54 EC exemption from the book profit. Now, there is no specified adjustment regarding that under the explanation 1 to 115JB. There is no explanation regarding that, right? However, the Madras High Court in metal and chromium platter case, Madras High Court in metal and chromium platter case had clearly held that 115JB, if is applicable, then in that case all the regular provisions of the Act will be applicable. Now capital gain which is forming part of the book profit, in respect of which 54 EC is available for the normal provisions, that should not be taken into account for calculation of the book profits. So 54 EC which is available for computing the total income under the normal provision should not be taken into account for computing the MAT profits, MAT book profit, because that is not a specified adjustment. CBDT had also in 2001 had given a circular wherein it had provided that all the provisions of the Act apply to the assessee which is opting for, which is required to pay under the MAT, which are in the nature of the interest, the advance tax, the assessment, everything will be applicable. So when the book profit is deemed to be the total income, all the provisions of the Act are applicable to the 115JB book profit also. Are we clear? And CBDT had in fact clarified that exemptions and deductions which are available under the regular provisions would not be available under 115JB unless specifically provided for. So yes, interest under 234B, 234C will be applicable. But unless the exemptions and deductions which are available under the regular provisions would not be available unless expressly provided for in explanation to 115JB. For example, we have the exemption available of 10, 11 and 12 on the book profit if it is credited to the P&L account. Right? The Madras High Court in this particular case of metal chromium had in fact held that the adjustment for the 54 EC will be available while computing the income, while computing the book profit under 115JB, even though that is not expressly allowed. So Madras High Court in this case had in fact allowed the book profit, 54 EC exemption, even though it is not expressly allowed by the CBDT. So this is the case law what I wanted to highlight to you. So in Volta, it has been held that all the regular provisions will be applicable. But the CBDT had clarified that the regular provisions would not mean that the exemptions and deductions will also be available unless specifically provided for. But the Madras High Court had granted this relief to the assessee by providing that 54 EC will also be available even if there is no specific adjustment provided for that. Are we clear? So you can write it down. 54 EC available against book profits. Clear? Okay. Now the last part, which is what is left discussing under the MAT, is the foreign tax credit and the MAT liability. Now, what is foreign tax credit? If you pay the taxes in the other country, then as per DTL and as per section 90, you get the credit of those taxes in India. Now, the issue which arises is that let's say if I have to pay the tax in India as per MAT, and also I have the MAT credit as well as the foreign tax credit which is available to me in the next year. So then what is the credit or what is the mechanism for claiming that particular credit? So for that purpose, the mechanism is provided. Now, what is the mechanism which is provided? Let's try and understand that thing. So in case where I have the MAT credit which is available to me, in case where I have the MAT credit which is available to me, now, and if I also have the FTC is also available to me. So I have the MAT credit, I have the foreign tax credit, both available to me. So will I be required to claim both? Or will I be required to claim only one? So that's what we have to understand now. So in a case where the foreign tax credit is available, let's understand this thing with the help of the example. Let's understand with the help of the example. So MAT credit and FTC. Let's say tax as per normal provision, and this is tax as per MAT. Now this is my tax liability, 1,50,000, right? And 1,75,000. Right? I have the foreign tax credit, which is 1.6 lakh and 1.6 lakh. So I have paid the taxes in US and that is now available to me as the credit. Now, what does the provision provides that? Where the tax credit, where the foreign tax credit is allowed against the tax payable as per MAT. Right? But it exceeds the amount of tax credit available or admissible against the normal provisions. Now, in this case, here my normal tax liability is 1.5 lakh. My MAT liability is 1.75 lakh. Right? Now, in this particular case, I have the foreign tax credit which is available only of 1,50,000 as per the normal provisions. But if I go under MAT, then the FTC which is available is 1.6 lakh. Right? Then what they say is deduction of FTC will be lower of A or B. Lower of A or B. So A or B, whichever is lower, that much I will be allowed the FTC. Now in this case, here it is 1.5 lakh, here it is 1.6 lakh, right? If I go as per normal, then it is 1.5. This is under section 90. Now what is my excess FTC if I am going as per the normal provision? So if I'm going as per the normal provision, the excess FTC was 10,000, which is allowed under the MAT, right? So 10,000 is allowed under the MAT, which was not allowed as per the normal provision. Now what will be my MAT credit? What is my MAT credit in this case? 25,000, right? 150 minus 175, 25,000 is my MAT credit. Since I am allowed the higher FTC over here, naturally my MAT credit should reduce. Right? So 10,000 was not available over here, but here I am allowing that extra 10,000. So the MAT credit as reduced by excess FTC. So 15,000 will be allowed to me as the MAT credit instead of 25,000. Are we clear? So 15,000 is the MAT credit which will be allowed to me instead of 25,000. Okay? Got this? Any doubt? Any questions? Any doubt? So when you have the FTC as well as the MAT credit, then in that particular case, to the extent the FTC is exceeding in the normal provision as compared to the MAT provision, then the excess will be reduced from the MAT credit and the balance MAT credit will only be allowed to you. Are we clear? Any questions? Any doubt? Now, MAT is not applicable to a company who is carrying on the life insurance business as well as who has exercised the option under 115BAA and 115BAB. To that, MAT is not applicable. Clear? Also, to certain foreign companies, MAT is not applicable if the foreign company is a resident of a country with which India has a DTAA and the foreign company does not have a PE in India, or the foreign company is a resident of a country with which India does not have a DTAA, but that foreign company is not required to seek any registration under the Companies Act, then in that case, the foreign company is not required to apply the MAT provision. So you can write it down. MAT not applicable to life insurance companies opting for section 115 BAA and 115 BAB provision. Then the foreign company which are resident of country with which India has DTAA and who does not have PE in India. Foreign company not required to seek registration as per Companies Act. Are we clear? For units located in IFSC, the MAT rate is 9%. The MAT rate is 9%. Okay. Also, MAT is not applicable to a foreign company where the total income of the foreign company consists of the presumptive profits under 44B, 44BB, 44BBA or 44BBB. So, foreign companies' total income consists of presumptive profits under section 44B, BBB, BB or BBA. Okay, in that case, the company is not required to have the MAT liability. Now, last one provision is in respect of adjustment in tax payable on book profit on account of the advance pricing agreement. Now, what is advance pricing agreement? Advance pricing agreement is like the advance ruling for the transfer pricing cases, wherein you enter into an agreement to determine the transfer pricing methodology, right? So, where there is the increase in the book profit due to the transfer pricing methodology agreed with the tax officers, on account of the advance pricing agreement entered into with the SSC, or if there is any secondary adjustment. So if the transfer pricing proceeds are not returned back, there will be secondary adjustment. This all you will understand again in detail when we'll go to the transfer pricing class. The AO, so the SSC may make an application to the AO to recompute the book profits. So then the AO will have to recompute the book profit, taking into consideration the tax payable on the book profits of the past year income as per 115 JB, and it will have to consider the tax payable including that income under the advance pricing agreement. Okay, so that we'll do it later also when we'll do the transfer pricing provisions. So any other questions in the MAT? Any other question in MAT? Is MAT clear? Okay, if the MAT is clear, let's move forward to the next provision. So we have to finish today the buyback tax. That is the one provision what I'm going to finish. And then we have to finish the securitization trust, and if the time permits, the AIFs. And then we will be doing in the next to next class. Okay. So this is what we'll be doing today. Let's quickly get started with the buyback tax. Just write it down. The buyback tax. Now, under the buyback tax, what are the provisions? Let's try and understand. So if you remember, we had done in the capital gain also, there was the tax and there was capital gain chargeable in the hands of the shareholder under section 46A. Do you remember that table? Can anybody tell me what was 46A? When the capital gain is chargeable in the hands of the shareholder, when it is chargeable in the hands of the company as the buyback tax. Do you remember that? This table I was talking about. Do you remember this? Say no, you have forgotten. Right? You have forgotten. You are not revising, as I'm saying to you. In exam, you will have to remember all these provisions. Do you remember? Okay. Do you recollect? Let me put it this way. We have done this. Do you recollect? Yes or no? Please reply fast. What was it? So if you have the buyback of shares by the domestic company, there is a buyback tax of 23.296% under section 115QA. Income is exempt in the hands of the shareholders under section 1034A. If the buyback of the shares or securities is by any other company other than the domestic company, or it is a buyback of ESOPs, or if it is a buyback of the specified securities by any company, domestic or foreign, then the taxability is there in the hands of shareholder under section 46A. Now do you recollect? Yes or no? I'm not getting any answers. Nobody recollects, nor they remember. Is that right? At least say yes or no to that. Okay. So I'm just again copy pasting this for your benefit. How do I copy paste this? Yes. You cannot copy paste this because you are writing on notebook, so you cannot copy paste it, right? I can do it here. Okay, yes, done. All right. Okay. So buyback tax is applicable in the hands of the domestic company if it is buying back these shares, right? Now this tax which is there is at the rate of 20% plus surcharge of, so this is, this is copied just halfway for the shareholders. I'm writing it down, exempt under section 1034A, and here it is taxable under section 46A. Consideration received minus cost of acquisition. Okay. Now 20% is the tax plus surcharge of 12% plus 4% cess, which makes to 23.296%. This tax has to be paid within the 14 days from the date of payment of the consideration, right? Now, what is this tax on? This tax is on the consideration paid by the company on buyback of shares as reduced by the amount which was received by the company for issue of shares. So this amount is on consideration paid minus consideration received on issue of shares. Now for this purpose, CBDT has introduced, to compute this amount, CBDT has introduced rule 40BB. Rule 40BB provides the manner of determining the amount received by the company for issue of shares which are bought back. Now, where shares have been issued by way of the subscription. So, if the shares have been issued by way of subscription, shares issued by way of subscription, this particular rule is to determine this amount. Okay. Then what is the amount received by the company? It is the amount of share application money plus the premium, right? So amount actually received plus the securities premium, right? Plus the securities premium. So this I will write it as A and this I will write it as B. So this is to determine the B. Okay. Then where the company had prior to the buyback returned any sum. So then you will reduce that sum. Return any sum prior to buyback, reduce that. Where the shares have been issued as the under the ESOPs, then in that case, if the shares issued as ESOPs or under the ESOPs policy of the company, then the fair market value of the shares. Fair market value of the shares, to the extent the amount is credited to the share capital and to the securities premium. Clear? Where the share has been issued by the amalgamated company in lieu of the amalgamation. Shares issued by amalgamated company during amalgamation. Then what is the amount received? The amount received by the amalgamating company. Amount received by the amalgamating company. Where the shares are issued by the resulting company under demerger. Shares issued by resulting company under demerger. So in that case, the amount received by the resulting company will be how you determine the cost of acquisition under 49 2C and 2D. Amount received by the demerged company in respect of original shares into net book value of assets, net book value of assets transferred in demerger divided by net worth of the demerged company before demerger. And what is the amount received by the original company? So amount, this is for the resulting company, and for the original company, it will be amount received minus this amount. Minus this amount. Amount calculated above. The same way you do the cost of acquisition calculation under 49 2C and 49 2D. Clear? Where the shares have been issued on conversion of preference shares or on conversion of debentures. Shares issued on conversion of preference shares or debentures. Then the amount received for preference shares or debentures. Where the shares have been allotted without any consideration. Where the shares are allotted without any consideration. In that case, nothing is received, so it will be nil. Okay, then it will be nil. Where the shares have been allotted as a part of acquisition of any asset or settlement of any liability. So I have allotted the shares because I wanted to acquire something or I wanted to settle my liability. Shares allotted in exchange of asset purchase or settling liability. Then the amount received is A or B. Amount received is amount received is A divided by B. What is A? A is the lower of FMV of the assets and liabilities. FMV of the assets and liabilities into the consideration paid by issue of shares. Paid by issue of shares divided by total consideration. Divided by total consideration. And B is lower of A or B, the consideration for acquisition of asset or settlement of liability to be paid through the shares to the extent credited to the share capital and security premium account. So, consideration paid by shares. Right? So, this is A. A is where the part consideration is in cash and part is in through shares, and B is only if it is through shares. And divided by B, B is the number of shares issued by the company. So B is number of shares issued by the company. Okay. Where the shares have been allotted by a company on conversion of a firm into a company or succession of a proprietary concern into a company. So shares allotted on conversion of firm or sole proprietary concern to company. Then in that case, A minus B divided by C. What is A? Book value of the assets. A is the book value of the assets. Right? B is the book value of liabilities. Of course, you will not consider any taxes paid, any refunds which are there, right? Any unamortized expenditure, any capital amount, reserves, provisions, all of that you will not consider. And C is the number of shares issued. Number of shares issued. Are we clear? So this is how you will compute the A minus B for the purpose of determining the consideration received on issue of shares. So for buyback tax to be applied, this is on A minus B. A is the consideration paid and B is the consideration received. And if you do not pay the buyback tax within 14 days, then the interest at the rate of 1% per month will be chargeable. Clear? So this is a small provision of buyback tax. Then we move towards the next important aspect of securitization trust. Let's get started with that. So this is what are the securitization trusts. First, let's try and understand what are securitization trusts. And then only you will be able to understand the taxability of that. Now, securitization trusts are special purpose vehicle, right? They are incorporated under the Sarfazi Act or under the SEBI Act, right? Now what they do is, let's try and understand with the help of example. Let's say there are banks or the financial institutions, right? Now, there are these borrowers who may obtain the loans from the bank. They will take the loans from the bank and they will mortgage their assets, right? They will mortgage their assets. Now, what the banks will do is, bank also need the money. So what bank will try to do is, it will give the assets to the securitization trust. It will give the assets, these assets, it will give to securitization trust and will obtain the funding for the banks. Right? Now, this securitization trust, how is it formed? This securitization trust has investors who are qualified institutional buyers, right? Now, this securitization trust will issue the security receipts for obtaining the funding. Will issue the security receipts and will get the funding. Now, securitization trust, what it gets is, it receives the interest from the bank on the funding given from the bank or financial institution, and it pays interest to the investors on the security receipts, right? So it receives the interest, it pays the interest. So now you will understand the taxability of the securitization trust. Now, income in the hands of the securitization trust is exempt. So the income of the securitization trust is exempt under section 1023 DA. It is exempt under the 1023 DA. This is a pass-through entity. What is a pass-through entity? Meaning the income will not be taxed in the hands of the securitization trust, but income will be taxed in the hands of the investor. So, this is passed to the investors, right? The income, this interest is not taxable. When it pays the interest to the investors will have to pay the taxes on the interest of the securitization trust. So the income is taxable in the hands of the investors. So taxability, or you can write it here, taxability passed through to investors. So section 115 TCA, 115 TCA provides that the income which is accruing or arising to or received by the investor from the securitization trust out of the investments made in the securitization trust shall be taxable in the hands of the investor in the same manner. The taxability will be in the same manner and as if the investor had directly invested in the underlying assets and not through trust. So it will be considered as the income of the investor in the same manner as if it was the income of the investor directly investing in the banks and not through the trust. So securitization trust is a pass-through entity, meaning it will not be taxed, but its income will be taxed in the same manner as if it was taxed in the hands of the securitization trust only, in the hands of the investor. Are we clear? The nature of income will also remain same in the hands of the investor. So the income which is paid to the investor shall be deemed of the same nature and in the same proportion as if it was of the securitization trust. Right? So it will be taxed in the same manner and in the like extent. So the income paid by the securitization trust shall be deemed to be of the same nature and in the same proportion in the hands of the investor as if it was received to the securitization trust. Are we clear? So securitization trust, then how will you say that how will the investor know how much is the house property income, how much is the business income, or how much is the other sources? So for that, the securitization trust will give the statement of the income to the investor as to what is the nature of the income in the hands of the securitization trust. Are we clear? Now, what are the TDS rates here? So securitization trust has to deduct the TDS on, or you can write it here, this on this, TDS on income payable to investor. And what is the TDS? In case of resident, individual or HUF, it is 25%. Other resident payee, it is 30%. For non-resident, is rates in force. For non-resident, it is rates in force. Now, what is rates in force? Rates in force means the rate under the Act or under the DTAA, whichever is lower. So, rates in force is defined in the 237A. This means rate under the Act or rate under DTAA, whichever is lower. The TDS rates are given under section 194 LBC. Under section 194 LBC. Are we clear? So this is the securitization trust. Any questions, any doubt? Clear? Okay. The next one is the income from the AIFs. What happened to this? Okay. Give me a minute. There was some problem. AIFs, alternate investment funds. Now, what are these? Let's try and understand what are the AIFs. Now, AIFs are the investment funds which basically invest into the other securities, other investment areas which are there, right? So, how these AIFs are taxed? Now, again, AIFs are the pass-through entities basically. These are nothing different than the securitization trust. These are more or less like the pass-through entity, like what I mentioned for the securitization trust itself, right? But how do we compute the income? Let's try and understand for the AIFs as well. Here, what is more important is the treatment of losses, which is there for the AIFs, which was not there in the case of the securitization trust. Okay. So that is the only difference which is going to be there. And of course, the tax rates will differ a bit. Let's try and understand. Okay. So under the AIF, which is the alternate investment fund, here you have the investment fund, which is there, which is incorporated as a trust, and then the investors are there. Now this fund will invest in the other assets, right? So now, as far as the income of the investment fund is considered, if it is profits and gains from business profession, it is taxable in the hands of the investment fund, and it is exempt in the hands of the unit holder. This is exempt in the hands of the unit holder under section 1023 FBB. This is taxable in the hands of the fund and it is exempt in the hands of the unit holder. Now, income other than the PGBP is exempt in the hands of the trust under section 1023 FBA, and this is taxable in the hands of the investor. Now, when I say this is taxable in the hands of the investor, now this will be taxable in the same manner as if the investor or the unit holder would have directly invested in the asset. And the nature of income will also remain the same in the hands of the unit holder. So taxable in the same manner and like extent, like what we have it for the securitization trust. But for securitization trust, all of the income, here only income other than PGBP. This is under section 115 UB. Alright, this is under section 115 UB. Now, since this is taxable in the hands of the unit holder, the investment fund needs to deduct the TDS. So there will be the TDS obligation under section 194 LBB. There will be TDS obligation under section 194 LBB. For the resident unit holder, this is 10%. For the resident unit holder, it is 10%. For non-resident, it is again rates in force. Okay, that is rates in force. So in case the income is payable to a non-resident, it is rates in force. Now, with respect to the losses, there is, as I said, the important determination over here. If there are any losses under PGBP, under the head PGBP, now since the income is also taxable in the hands of the investment fund only, the losses will also be allowed to be carried forward by the investment fund. And that will not be passed to the investor. So this will be carried forward and set off by the fund and not passed to the investors. Not passed to the investors. And losses which are other than PGBP, losses other than PGBP. Now, if there are losses other than the PGBP, and if the units are held for at least 12 months, if the units are held for at least 12 months, units held for at least 12 months, and if the units not held for 12 months, then there will be different conclusions. If the units are held for a period of at least 12 months, then in that particular case, the losses will be allowed to be carried forward and set off by the unit holder. Then the losses will be allowed to be carried forward and set off by the unit holder. So unit holder can carry forward and set off the losses. So there is pass-through of losses also, which was not there in securitization trust. But the unit should be held for at least 12 months. And the fund cannot carry forward the losses. If the units are not held for at least 12 months, then the unit holder is not required to carry forward and set off the losses. But whether in that case the fund can do that, the act is silent. The act is silent and therefore no treatment is prescribed around this. The act is silent in this regard, whether the investment fund can set off or not. Are we clear? So in that manner, the unit holder cannot do that if it is held for less than 12 months, but the fund can do that or not, the act is silent. Are we clear? As I said, the income will be taxed in the hands of the unit holder if it is other than PGBP, and the nature of the income will also be dependent on how the investment trust has characterized the income. So for that purpose, the investment trust will have to furnish the statement. Right? Now, what is the total income of the fund? It is only the income which is under the head of PGBP, which is taxable in the hands of the investment fund. Now, the tax rate for that will be 30% or 25% in case of the company or a firm. If it is tax rate is for a company or a firm, it will be 30% or 25%, as the case may be, for a company, and 30% for the firm. Or let me write it reverse equation. 25% for company, 30% for firm. For others, this is going to be the maximum marginal rate, the highest rate. Are we clear? And every investment fund has to compulsorily file the return of income. Every investment firm has to compulsorily file the return of income under 139. Are we clear? Any doubt? Should we solve a question on this to understand the losses? Okay. Now there's a sum from your module only again. I'll take you to the module for that. Following are the particulars of 3 investment funds for previous year 21-22. Business income, capital gain, income from other sources. There is loss, there are profit also. Compute the total income of the investment funds and each unit holder for AY 22-23, assuming that each investment fund has 20 unit holders, each having 1 unit held by them for a period exceeding 12 months, and income from investment in the investment fund is the only income of the unit holder. If investment fund C has the following income components for AY 23-24, what would be the total income of the fund and unit holder of that year? Business income, capital gain, income from other sources. So tell me the answers. What will be the income of the A fund first? And what will be the unit holder's income? No, Kaushiki. How 16 investment fund? As I said, for the investment fund, only business income is taxable in the hands of the investment fund. 16 is the capital gain tax. So how it will be taxed in the hands of the fund? Both these income, capital gain and the income from other sources will be taxable in the hands of the unit holder, and it will not be 16 and 4 because 16 and 4 is total, but there are 20 unit holders. So it will be 80,000 and 20,000 for the income from other sources, because 16 lakhs divided by 20 gives us 80,000 as the capital gain and income from other sources as 20,000. So income of the fund is nil and income of the unit holder of A will be 80 and 20, which will be 1,20,000. Both will be taxed in the same proportion, which is as given, which is capital gain will be 80 and 20 will be income from other sources. Are we clear? What about B? What about the fund B? Yes, 2 lakh of the investment fund and then 90,000 of the unit holder. So 2 lakh, which is the business income, yes, Kaushiki, that will be taxable in the hands of the fund, and the balance amount, which is in the same ratio in the capital gain and other sources, will be taxed in the hands of the unit holder. Then what about the fund C? What about the fund C? No, Kaushiki, that's not correct. So With respect to the fund C, which is there, so you have rightly mentioned that B is to be carried forward and set off by the fund. But see, the 8 lakh which is there is the income from other sources, right? So before I will distribute 8, I will set it off 2 against 8. I will not distribute the entire 8. I will set off 2 against 8. So therefore, in the hands of the fund, investment fund C, business loss of 2 lakh is set off against the income from other sources of 8 lakh. Now 6 lakh only will then get distributed to the investors. Now out of that 6 lakh, there are 20 unit holders. So therefore 30,000 will be taxable in the hands of the unit holder C. As far as the capital gain is concerned, the act is not silent with respect to the other income where the unit holder holds the unit for a period of more than 12 months. The act is silent where the unit holder is holding the units for less than 12 months. If the unit holder is holding for more than 12 months, the act is very clear that the unit holder is only allowed to set off that particular amount. So capital gain loss, since it cannot be set off against any other income, the unit holder will be required to carry forward and set it off. Are we clear? Are we clear? So the unit holder will be allowed to carry forward and set off because the unit holder is holding the units for more than 12 months. What about then the fund D? Fund D. Five is the income of the investment fund. No, Kaushiki, that's not correct. So again, the income from other sources can be set off against the business income. Income from other sources loss. So first you will set off the loss of the other sources against the business income of 5 lakh, and only 3 lakh will be taxed as the business income of the fund. Like we did it for the business loss against the income from other sources, we will first set off at the fund level, and the carry forward we will do it in the investor's hand or in the hands of the fund. First, the set off will be done and only then the income will be distributed. Clear, Kaushiki? So, the 3 lakh only will be taxable in the hands of the fund, and in the hands of the unit holder, out of 20 lakh of capital gain, only 1 lakh will be taxable. And there will be no carry forward because it is set off at the fund level. Clear? Then the last part says, if the investment fund C has the following income components in the next year, what would be the total income of the fund and the unit holder for that year? Business income, capital gain, and income from other sources. What about the last part? Yes, 2 lakh will be taxable in the hands of the investment fund. As far as the investor is concerned, you have the brought forward capital loss of C, right? So 30,000, 6 lakh was the total capital loss. Out of that, investors' proportion will be 30,000. Now 30,000 you will first set it off against 45,000, which is the capital gain of the investor. Out of that, only the 15,000 will be taxable, right? So 30,000 will be set off against 45,000 capital gain. So 15,000, and the other sources is 40,000. So 15 plus 40, which is 65,000, will be taxable in the hands of the investor. Are we clear? Now for the tax rate of the fund will be 25% or 30% as the case may be, depending on the whether it is a firm or whether it is a company. And if the fund is a company, then it could be 25%. And in any other case, it will be maximum marginal rate. Clear? Not 9 lakh, na, Anarga. So you will have to divide it proportionately between the unit holders. Do you have any questions? Any doubts? Is AIF clear? Perfect, Kaushiki. Any other questions? Okay. Anarga, it is clear? Okay, last one thing before we close the session. I will do it, which is in respect of the individual taxation. We are, of course, yet to do the REIT. REIT we will do tomorrow, but individual tax, which is a small part, I'll finish it off today. So, individual taxation, right? So, what are the slab rates which are applicable for the individual? For the individual, the slab rates are up to rupees 2.5 lakh, it is nil. Then 2.5 lakh to 5 lakh, it is 5%. 5 lakh to 10 lakh, it is 20%. And greater than 10 lakh, it is 30%. For resident senior citizen, which are greater than 60 years at any time during the year, it is up to rupees 3 lakh, nil. 3 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. And greater than 10 lakh is 30%. For resident super senior citizen, which are over 80 years at any time, up to rupees 5 lakh, it is nil. Then 5 lakh to 10 lakh, it is 20%. And greater than 10 lakh, it is 30%. Right? But these are only if it is a resident. If it's a non-resident senior citizen, then the 2.5 lakh limit will be applicable. Right? Now, there is also a provision optional scheme under section 115 BAC. Like we have it for companies, we also have it for the individuals, which is under section 115 BAC. Now, what does section 115 BAC provide that? 115 BAC provides for the optional scheme. Now, optional scheme is provided, which is, what are the slab rates? So, this is for all the individuals, resident or non-resident, right? So, up to 2.5 lakh, it is nil. Then 2.5 lakh to 5 lakh, it is 5%. Then 5 lakh to 7.5 lakh, it is 10%. Then 7.5 lakh to 10 lakh, it is 15%. Then 10 lakh to 12.5 lakh, it is 20%. Then 12.5 lakh to 15 lakh, it is 25%. And greater than 15 lakh, it is 30%. Right? So this is your new scheme. If you compare it with the old one, the normal one up to 2.5 lakh, it is same, nil. 2.5 to 5 lakh, it is same, 5%. 5 lakh to 7.5 lakh. In the old, 5 lakh to 10 lakh goes directly into 20%. So 5 lakh to 7.5 will also be 20%. 7.5 to 10 will also be 20%. Over and above 10 lakh, it is directly 30%. So in all these cases, if you see, you are benefiting in these cases where it is becoming 10, it is year 20, it is year 15, it is still 20, it is year 25 and 20, it has become 30. Right? So here, if you see, you are benefiting in the new regime. Even for greater than 60 and greater than 80, if you compare, so here it is nil. Here 2.5 to 5 lakh, up to 3 lakh, it is nil. Right? Over and above 3 lakh, it is 5%. Whereas over and above 5 lakh to 10 lakh, it is directly 20%. Whereas here you are getting 10, 15 and over and above 10 lakhs, here you have 30, whereas here you are still benefiting. In case of super senior citizen, it is nil up to 5 and 5 to 7.5, it is directly 20 and then it is 30. But if you want the benefit of new scheme, then you should not claim any deduction or exemption. No deduction or exemption for leave travel concession under section 10(5). HRA under section 10(13)(a). Then SEZ units under section 10(AA). Then standard deduction under section 16, which is for the salaries, entertainment allowance, professional tax, all these under section 16 not available. Interest on self-occupied property under section 24 not available. However, interest on let out property is available. Interest on let out property is available. Then additional deduction under additional depreciation under section 32(1)(2)(a). Then tea, coffee, rubber development, site restoration fund, scientific research under 35, investment allowance under 35(AD), all this is not available. Family pension under section 57, which is 1/5, which is allowed, that is also deduction not available. 80C to 80U not available. Only two deductions are available, which is employer contribution to pension scheme under section 80CCD2, which was 14% and 10%, right? And the 80JJAA. Only these two deductions are available. So what are the allowances which are available? Traveling allowance is available. Then conveyance allowance, daily allowance is available. Right? Then interest on or the transport allowance for the handicap is available, which is 3,200 up to rupees 3,200 per month. Then interest on let out property is available. Self-occupied is not. Employer contribution to pension scheme under section 80 CCD 2. Depreciation is available, not the additional depreciation in 80 JJAA. Are we clear? Now, individual or HUF having PGBP are required to exercise the option. The time limit is this option needs to be exercised before the due date of the filing return of income under section 139(1). Even for individual or HUF not having business income, the option has to be exercised before the due date of filing ROI under section 139(1). Now, once this option is exercised for the individuals having business income, it cannot be withdrawn. So once the option is exercised, it cannot be withdrawn. So for individual or HUF having the business income, once the option is exercised, then it cannot be withdrawn. Are we clear? So then the option cannot be withdrawn specifically. So you can exercise the option and then you will not be allowed to remove that particular option. You cannot say in 1 year I will exercise the option, in the other year I will not exercise the option. So if you exercise the option, then you will not be allowed to exercise the option again, or withdraw from that particular option. Are we clear? The option can be withdrawn only once where it was exercised by the individual, and thereafter if he withdraws it, then he will never be able to go back. Okay. So if withdrawn cannot go back to 115 BAC. If you withdraw, then you cannot go back to 115 BAC. Are we clear? Any doubt? So then you cannot go back unless the business ceases to exist. Unless business ceases to exist. If your business is stopped, then you can again go back. In case of the individual or HUF not having the PGBP, then in that particular case, you can intimate the option year on year by filing the return of income and choosing that option. So you can change the option year on year, every year. As far as your TDS liability is concerned with the employer, you have to intimate about the optional scheme before the start of the year. So in case you do not have the business income, then in that particular case, you need to intimate the option to your employer before the start of the year. Intimate the option to employer before start of previous year. And once you have intimated the option to the employer, you cannot again go in the next month and say to the employer, no, I want to opt out. Whether you can opt out at the time of filing the return, yes, you can opt out at the time of filing the return. But you cannot again and again change the option with your employer in that particular year. Okay. So option cannot be changed with the employer changed with the employer, but can be changed while filing return of income. This is for the assessees who do not have the business income. Are we clear? Now, if you fail to satisfy the conditions, in case of the individual not having the business income, the option exercise would become invalid. So, if you fail to comply with the conditions, failure to comply with conditions, then the normal provisions will apply. Option will become invalid. Right? Your option will become invalid. And in case of the individual having the income from business, for them also the option exercise would become invalid and the normal provisions will then be applicable. Here also note that AMT is not applicable for individuals or HUFs exercising the option under 115 BAC. So AMT will not be applicable in this particular case. Okay. So individuals not having the business or profession income, they may require to compare under the normal provisions as well as under the new provisions and then decide whether to opt in or opt out of the 115 BAC every year. But for the business or profession, they have to intimate the option at the time of filing the return. Only once they can withdraw, and if they withdraw, they will not be able to go back. Are we clear? Any questions? Any questions? Any doubt? Any questions? That will be available. Capital gain exemption will be available, Anarga. That is not restricted. Okay. So thank you so much, students. See you in the next class. Please revise what we have done so far. Okay. Thank you so much.